Question 7. Are there any alternative investment strategies that could achieve similar risk reduction goals? Absolutely. While HELO ETF offers a unique approach with its laddered options overlay, there are several alternative investment strategies that can achieve similar risk reduction goals within your portfolio. Here are some options to consider. 1. Diversification across asset classes. The core principle, the most fundamental approach to reducing risk is diversification. By spreading your investments across various asset classes with low correlation, meaning their prices don't move in the same direction, you can mitigate the impact of a downturn in any single asset class. Examples: this could involve allocating a portion of your portfolio to asset classes like bonds, real estate investment trusts, REITs, commodities, or even cash equivalents. Each asset class has its own risk-return profile, and combining them helps create a smoother overall portfolio ride. 2. Low-volatility ETFs. Passive approach. These exchange-traded funds passively track indexes designed to capture stocks with historically lower volatility than the broader market. This doesn't eliminate risk entirely, but it can potentially reduce the magnitude of potential losses during market downturns. Examples: some popular low-volatility ETFs include SPDR SP500 Low Volatility ETF, SPLV, iShares MSCI USA Minimum Volatility ETF, USMV, and PowerShares SP500 Low Volatility Quality Portfolio ETF, SPLQ. 3. Strategic asset allocation. Dynamic approach. This strategy involves actively adjusting the allocation of your portfolio across different asset classes based on market conditions. During periods of high market volatility, you might allocate a higher percentage to less volatile assets like bonds, and then adjust back towards equities when the market stabilizes. Implementation. This strategy can be more complex and might require more investment knowledge or the help of a financial advisor. 4. Put options on broad market ETFs. Similar strategy, simpler implementation. This approach involves directly buying put options on broad market ETFs like SPY, tracks the SP500. Similar to HELO's strategy, these options offer downside protection but come with the cost of the option premium. However, unlike HELO, you have more control over the strike price and expiry date of the options you purchase. 5. Portfolio put options. Tailored protection. This strategy involves buying a customized put option contract that covers your entire portfolio instead of focusing on a specific index. This can offer more targeted downside protection for your specific holdings, but it's also likely to be a more complex and potentially expensive option. Choosing the right strategy. The most suitable alternative for you depends on your risk tolerance, investment goals, and level of investment knowledge. Diversification and low volatility ETFs. These are generally simpler strategies suitable for a broad range of investors seeking a basic level of risk reduction. Strategic asset allocation and options-based strategies. These require a more active approach and might be better suited for investors with a higher risk tolerance and more experience managing their portfolios. Remember, it's always wise to conduct your own research and consider consulting with a financial advisor to determine the best risk reduction strategy for your specific circumstances. Question 8. How does HELO ETF compare to other low-volatility ETFs in terms of fees, strategy, and historical performance? Here's a breakdown comparing HELO ETF to other low-volatility ETFs across fees, strategy, and historical performance. Fees. HELO likely has a higher expense ratio, potentially in the range of 0.40% to 1.0%, due to its actively managed options overlay strategy. Low-volatility ETFs generally have lower expense ratios, around 0.20% to 0.30%, because they passively track low-volatility indexes. Strategy. HELO uses a laddered options overlay on top of a large cap equity portfolio. This aims to limit downside risk during market downturns, but comes at the cost of potentially capped upside and higher fees. Low-volatility ETFs passively track indexes designed to capture stocks with lower historical volatility than the broader market. This offers a simpler and potentially more cost-effective approach to reducing portfolio volatility. Historical performance. HELO, due to its relatively short history, launched in 2023, data as of April 2024, it's difficult to definitively assess its long-term performance. However, it might outperform a traditional large-cap ETF during market downturns due to its options overlay, but potentially underperform during strong bull markets due to the cost of options. Low-volatility ETFs. Historically, these ETFs tend to exhibit lower overall returns compared to the broader market but also experience lower volatility. This translates to a smoother ride with smaller drawdowns during market corrections. Choosing between them. HELO might be suitable for investors seeking downside protection during market downturns, even if it means potentially capped upside. A more actively managed approach with the potential for higher returns, although not guaranteed. Low-volatility ETFs might be suitable for investors seeking a simpler and potentially more cost-effective way to reduce portfolio volatility. Consistent lower volatility with potentially lower overall returns, compared to the broader market. Question 9. Are there any actively managed funds with a similar risk profile to HELO ETF? There are some actively managed funds that might offer a similar risk profile to HELO ETF, JP Morgan Hedged Equity Laddered Overlay ETF. Here's a breakdown to consider. Similarities. Downside protection focus. Both HELO and some actively managed funds aim to achieve capital appreciation while mitigating downside risk during market downturns. Active management. Both rely on active management strategies to achieve their goals. HELO uses an options overlay, while actively managed funds employ various strategies like sector allocation, stock selection, and dynamic portfolio adjustments. Differences. Specific strategies. Actively managed funds can have diverse strategies. Some might focus on option overlays similar to HELO, while others might utilize different approaches like hedging with derivatives or selecting defensive sectors and stocks with lower historical volatility. Transparency. HELO's options overlay strategy is somewhat transparent, but the specific details of actively managed funds can be less transparent. Their holdings and the rationale behind their investment decisions might not be readily available to investors. Fees. Actively managed funds generally have higher expense ratios compared to both HELO and low-volatility ETFs due to the complexity of their strategies and the ongoing management fees. Finding similar funds. Category exploration. Look for actively managed funds within categories like market neutral or alternative income that often focus on capital preservation and downside protection strategies. Fund prospectuses. Research prospectuses of individual funds to understand their investment objectives, strategies, and historical performance. Look for funds that explicitly mention downside protection as a key objective. Financial advisor consultation. A financial advisor can help identify actively managed funds with risk profiles similar to HELO based on your specific investment goals and risk tolerance. Important considerations. Performance track record. Actively managed funds have a performance history, but past performance doesn't guarantee future results. Analyze their performance during different market conditions to understand their risk-adjusted returns. Manager track record. Research the track record of the fund manager and their experience in managing similar strategies. Fees and expenses. Compare the expense ratios of actively managed funds to HELO and low-volatility ETFs. higher fees can significantly impact your long-term returns. Here are some additional points to remember. Actively managed funds can be more complex and potentially riskier than HELO or low-volatility ETFs due to their less transparent strategies and potentially higher fees. Diversification is key. Consider incorporating HELO, low-volatility ETFs, and actively managed funds with similar risk profiles into a broader portfolio allocation to achieve your desired risk-return balance. By carefully evaluating these factors and conducting your own research, you can determine if an actively managed fund aligns with your investment goals and offers a similar risk profile to HELO ETF. Question 10. What are the broader market trends and risks that could impact the performance of HELO ETF? HELO ETF's performance is influenced by a combination of factors related to the underlying equity portfolio and the options overlay strategy. Here's a breakdown of the broader market trends and risks that could impact HELO. Market trends. Equity market performance, the overall performance of the U.S. equity market will significantly impact HELO. Bull markets. During strong market rallies, HELO's potential upside might be capped due to the cost of the put options. Bear markets. HELO's options overlay can provide downside protection during market downturns. However, the effectiveness depends on the strike price and timing of the put options. Volatility. HELO's options overlay is more expensive during periods of high market volatility. This can eat into returns if the market doesn't experience a downturn requiring the use of those options. Conversely, lower volatility periods might benefit HELO as the option premium would be lower, potentially allowing for higher returns if the underlying stocks appreciate. Interest rates. Rising interest rates can make stocks less attractive compared to fixed income investments. This could negatively impact the underlying equity portfolio of HELO. Market risks. Unexpected events, black swan events, unforeseen events with significant impact, or geopolitical crises can cause significant market disruptions. The effectiveness of HELO's options overlay in such scenarios is uncertain. Liquidity risk. If the options market becomes illiquid, especially for the specific options used by HELO, it might be challenging to adjust the overlay strategy or unwind positions. Counterparty risk. The risk of the issuer of the put options defaulting on their obligation, although low for reputable institutions, could negatively impact HELO if it's unable to exercise the put options. Additional considerations. Effectiveness of options overlay. The success of HELO's strategy relies heavily on the effectiveness of the options overlay in mitigating downside risk. Careful selection of strike prices and expiry dates is crucial. Management expertise. The expertise of HELO's management team in managing the options overlay and adapting it to changing market conditions is a critical factor for performance. By understanding these broader market trends and risks, you can gain a better perspective on the potential impact on HELO's performance. Remember, diversification across asset classes and investment strategies can help mitigate some of these risks and create a more resilient portfolio. Question 11. How will changes in interest rates or economic conditions affect the effectiveness of the options overlay? Changes in interest rates and economic conditions can affect the effectiveness of HELO's options overlay strategy in several ways. Interest rates. Impact on option costs. Generally, as interest rates rise, the cost of options, including the put options used by HELO, also increases. This is because investors can earn a higher return by holding cash, due to higher interest rates, compared to owning options. Higher option costs can reduce the potential upside for HELO, as a larger portion of the returns is used to pay for the options overlay. Discounting effect. Higher interest rates also impact how future cash flows, like potential stock dividends, are valued. This can affect the pricing of the underlying stocks in HELO's portfolio and the intrinsic value of the put options. Economic conditions. Market volatility. During periods of high market volatility, even if there isn't a significant decline, the cost of options, including put options, increases due to the volatility smile phenomenon. This can further strain the effectiveness of HELO's options overlay if the market doesn't experience a substantial downturn requiring the put options. Correlation between stocks and bonds. Traditionally, there's a negative correlation between stocks and bonds. When economic conditions deteriorate, investors might flock to bonds as a safe haven, causing bond prices to rise and stock prices to fall. However, in recent years, this negative correlation has weakened at times. This can affect the effectiveness of the options overlay if the underlying stocks in HELO's portfolio decline alongside bonds, limiting the put option's ability to hedge the downside. Effectiveness of the options overlay. Strike price selection. The effectiveness of the options overlay depends heavily on the strike price of the put options purchased by HELO. If interest rates rise and the underlying stocks don't decline significantly below the strike price, the put options might not be exercised, leaving HELO with the cost of the options but no actual protection. Overall impact. Potential for reduced upside. Rising interest rates and weaker economic conditions can lead to higher option costs and potentially reduce the upside potential of HELO compared to a scenario with lower interest rates and a stronger economy. Effectiveness during downturns. HELO's options overlay might still offer some downside protection during significant market downturns, even with higher interest rates. However, the effectiveness depends on the specific strike prices chosen and the magnitude of the decline. Here are some additional points to consider. The Federal Reserve's monetary policy plays a significant role in influencing interest rates. Understanding the Fed's stance and potential future rate hikes can help you assess the potential impact on HELO. Economic data releases and overall economic sentiment can also provide clues about potential changes in interest rates and economic conditions. By considering these factors, you can gain a better understanding of how changes in interest rates and economic conditions might impact the effectiveness of HELO's options overlay strategy. Remember, diversification and a long-term investment horizon are crucial for managing risk in any economic environment. Question 12. Are there any regulatory changes on the horizon that could impact the viability of the HELO ETF strategy? It's difficult to predict future regulations with certainty, but here are some potential regulatory changes that could impact the viability of HELO ETF strategy. Regulation of options overlays. Currently, there are no specific regulations solely targeting options overlays used by ETFs. However, regulators like the SEC, Securities and Exchange Commission, might introduce stricter rules in the future. These rules could address aspects like transparency requirements for the selection and management of options within the overlay. Limitations on the types of options used or the leverage involved in the strategy. Risk management guidelines for ETFs using options overlays. Impact on HELO. Stricter regulations could increase the compliance burden for HELO, potentially leading to higher fees. Limitations on option selection or leverage might restrict HELO's ability to implement its current strategy effectively. Regulation of leverage in ETFs. The SEC might introduce broader regulations on leverage used by ETFs, not just focused on options overlays. This could potentially limit HELO's ability to use leverage, if any, within its strategy. Impact on HELO. Leverage restrictions could limit HELO's potential returns, as it might not be able to amplify gains as effectively. Changes in margin requirements. Margin requirements are the minimum amount of capital an investor needs to hold to purchase options on margin. Regulatory changes could increase margin requirements for options trading. Impact on HELO. Increased margin requirements could make it more expensive for HELO to implement its options overlay strategy, potentially reducing its profitability. Mitigating factors. The SEC generally encourages innovation in the ETF industry, and new regulations might aim to balance risk management with allowing for strategic flexibility. HELO's management team would likely adapt their strategy to comply with any new regulations, potentially finding alternative ways to achieve similar risk-return objectives. Staying informed. It's important to stay updated on regulatory developments related to ETFs and options trading. The SEC website and financial news outlets can be good sources of information. Overall, while there's no guarantee of specific regulatory changes, it's wise to be aware of the potential for future regulations that could impact the viability of HELO's strategy. Alright, ETF fam, let's recap what we learned about HELO. It uses this options overlay strategy that aims to protect your investment from major market tumbles. Sounds pretty sweet, right? But remember, there's always a trade-off. Higher fees, potentially capped upside during bull markets, and the strategy's effectiveness, depending on some unpredictable factors. So, is HELO the right fit for you? It depends on your risk tolerance and investment goals. If you're a long-term investor seeking some downside protection, HELO could be an interesting option as part of a diversified portfolio. But definitely do your own research and consider consulting a financial advisor before taking the plunge. For more in-depth ETF analysis, don't forget to like and subscribe to Chat ETF. We've got tons of videos on low-volatility ETFs, actively managed funds, and everything in between to help you navigate the exciting world of ETFs. We're also active on social media. Mention your social media handles, so be sure to follow us there to join the ETF conversation. Thanks for joining us today, and remember, happy investing!